where we unpack a stack of information and distill it down to the most important nuggets of knowledge and insight for you. Today, we're diving into the Daily Financial Intelligence Brief, compiled yesterday, Monday, August 18th, 2025. The market data we're looking at closed as of last Friday, August 15th, but we've got some updates from Monday too. Our mission today is, well, it's really to cut through the noise of all those market movements and economic reports. We want to pull out the crucial details and, importantly, the connections that truly matter for your financial landscape. We're going to explore as a global cross-asset snapshot, try to understand the deeper drivers behind key market shifts, and look at the trending themes that could significantly impact your decisions. And this update, by the way, is powered by NextSight, a global intelligence company. They really align with our mission here of cutting through the noise. With their open-source OSINT platform, Sight Connect, they transform raw data into actionable strategy, helping clients shape reports around their exact priorities, much like we're trying to do for you with this deep dive.
Precisely. And this brief, it gives you a comprehensive look across equities, rates, currencies, commodities, even real estate. It's about connecting the dots, to see not just what happened on the surface, but why those movements occurred. And crucially, what larger implications they hold for the bigger picture you need to be aware of.
Okay, let's unpack this then, starting with U.S. equities. On Friday, August 15th, the S&P 500, Dow Jones, Nasdaq U Composite. They all saw slight pullbacks. But if you look at the full week, U.S. stocks actually had a pretty strong rally, didn't they? The S&P 500 gained about 1%, the Dow 1.66%, and the Nasdaq Q was up, 0.49%. So what was the primary force driving this broader weekly optimism, especially given that Friday dip?
Yeah, what's fascinating here is that the weekly rally, it was largely underpinned by two key data points, really. First, you had softer U.S. CPI data. It rose only 0.2% month over month and 2.7% year over year. So that offered some relief on the inflation front. Second, we saw surprisingly resilient consumer data, retail sales rising 0.5%. That actually beat expectations. So that combination, it gave investors a sense of relief, regarding both inflation and economic strength. However, and this is a crucial nuance that many might overlook, producer prices, the PPI, actually surprised to the upside, a significant 0.9% month-over-month jump. This divergence between consumer and producer prices, well, it reinforces the idea that the Federal Reserve might not be easing policy as quickly as some hope, creates a bit of a mixed signal for the market.
That divergence between CPI and PPI is quite striking. How does a mixed signal like that typically play out in the markets? And did we see any particular sectors react differently as a result?
Absolutely. Despite the overall weekly gains, that mixed signal and the Friday pullback, they highlight a subtle but, I think, important rotation within equities. We saw profit-taking in the mega-cap technology stocks, the ones that had led the market for so much of the year, while defensive sectors like healthcare and utilities, they actually outperformed. Now, this isn't just a slight adjustment. It often signals a shift in investor preference towards more stable, maybe less growth-dependent areas when uncertainty about rates or growth pops up. It makes you ask, right, is your portfolio sufficiently diversified, or are you maybe overexposed to growth if this trend picks up steam? Also worth noting, completely different area. European defense stocks have rallied incredibly strongly. Reuters highlighted astonishing gains, like 600% for Leonardo and 1,500% for Rheinmetall since the conflict began. That reflects a very different kind of macro trend.
Okay, so that's the stock market's reaction. Let's shift gears to bonds. We saw Treasury yields marching higher. The U.S. 10-year note hit 4.29%, and the 2-year was at 3.74%. What are the big implications of these moves, especially for the wider economy and what investors are expecting?
This raises a really important question for anyone watching the markets. What does it mean when both the 10-year and 2-year yields rise like that? And especially when their relationship shifts. It meant the yield curve steepened. It actually became positive for the first time since early 2022. Now, this isn't just, investment-grade credit spreads. They widened modestly to 0.75%. But look, they remain pretty tight relative to history. That suggests underlying strength, continued demand for high-quality corporate debt. High-yield spreads, the riskier end, stayed below 3% at 2.88%, even with a slightly softer risk mood overall. So this indicates that while investors are perhaps being a bit more selective, they're still willing to take on some credit risk for higher returns. It suggests a cautious environment, maybe, but not entirely risk-off. Liquidity is still there, even if sentiment isn't quite as bullish as it was.
Okay, the U.S. signals seem clear, but how are these trends playing out globally, especially in currency markets? The U.S. dollar index, the DXY, firmed up to 98.12. What's behind this dollar strength, and how do the other major currencies hold up against it?
Yeah, the dollar strength was definitely supported by those rising U.S. yields we just talked about. That's a big factor. Plus, you have the classic safe haven flows. When global uncertainties persist, investors often flock to the perceived safety of the dollar. It's just how it works. Conversely, the euro slipped down towards $1.17. It was weighed down by worries over weaker growth in the eurozone and those potential energy risks. The Japanese yen weakened further, around 147.7 per dollar. That really reflects the Bank of Japan's ongoing yield curve control policy and those widening interest rate gaps compared to the U.S. Sterling also softened, down to $1.31. That's despite the Bank of England actually cutting its policy rate to 4% and some strong GDP data. Investors seem to be waiting for clearer UK inflation figures before making big bets.
Right. Now, here's where it gets really interesting for a lot of our listeners. The crypto market. Bitcoin fell below $116,000, settling around $116,366. And Ethereum actually underperformed Bitcoin, closing at $4,366.38. What's happened in that space? Is this just typical crypto craziness, or is there maybe a deeper shift in sentiment this time?
Well, both Bitcoin and Ethereum saw retreats, yeah. It looks largely like profit-taking after some really significant gains over the past few months. Plus, you have heightened regulatory scrutiny kind of hanging over the market, which always weighs on sentiment. The market gets skittish when new rules are talked about or put in place. But, and this is important context, despite these recent pullbacks, Bitcoin is still up over 30% in the last 3 months, over 35% year to date, and Ethereum is similarly up over 20% in 3 months and nearly 33% year to date. So yes, they saw a dip, but the longer-term trend for the year remains quite positive. It indicates some underlying strength even with these short-term corrections.
Okay, from digital assets, let's turn to more tangible things. Commodities. Oil prices showed some volatility. Brent crude settled at $66.60 a barrel on Monday, August 18th after those talks in Ukraine, but it had actually fallen 1.1% the week before. WTI crude settled at $63.42. What's driving these ups and downs in the energy market?
Oil prices have definitely been quite responsive to geopolitical developments. That reflects global concerns and the impact of diplomacy, like those Ukraine talks you mentioned. Meanwhile, gold held near record highs, priced at $3,346.87 an ounce. Its strength is largely down to continued safe haven demand. Investors see gold as a reliable store of value when other markets get choppy. That's kept it elevated despite rising real yields elsewhere. As for natural gas, Henry Hub spot prices fell to $2.92 per MMBtu. That reflects moderating temperatures and pretty ample supply, which have pushed prices down. Classic supply-demand dynamics there. Also worth noting, U.S. crude inventories rose by 3 million barrels last week, while gasoline and distillate inventory saw slight declines. These inventory figures are always crucial. They give you a snapshot of the immediate supply and demand balance, often good leading indicators for future price moves.
And finally, let's touch on housing. From energy to bricks and mortar. What's the latest on real estate and mortgages? What should you be watching there?
Freddie Mac reported that mortgage rates actually edged a bit lower last week. The average 30-year fixed-rate mortgage was 6.58%. Down from 6.63% the week before. And the 15-year rate eased slightly to 5.71%. Now, lower borrowing costs, they should offer some relief to the housing market, right? Potentially attract more buyers, maybe ease the burden for existing homeowners. That's a welcome development. However, it's worth remembering that elevated home prices and, crucially, limited supply continue to restrain overall activity. It's not exactly a green light for a housing boom just yet. That supply constraint, in particular, suggests that even with slightly lower rates, affordability is going to remain a key challenge. And that could impact consumer spending elsewhere as people grapple with housing costs.
So we've covered a lot of ground today. Equities, bonds, currencies, crypto, commodities, housing. What does this all mean for the bigger picture? The brief highlights several trending themes and risks that you should probably be aware of navigating the coming weeks.
Absolutely. First, there's this ongoing debate, this tension between stagflation versus economic resilience. That contrast we talked about, softer consumer inflation versus those surging producer prices, it has clearly revived stagflation concerns for some analysts. Investors are watching really closely how firms manage their margins with rising input costs. Can they pass them on? Or will profits take a hit? The upcoming FOMC minutes and Jackson Hole will be absolutely key in getting more clarity on the Fed's thinking here. A second critical theme is the persistence of geopolitical risks. The U.S.-Russia summit, European leaders' ongoing support for Ukraine, all this heightens geopolitical uncertainty and creates ripples across markets. Reuters even noted some speculation that, cooperation in the Arctic could unlock untapped oil reserves, potentially spurring a deep energy bear market. Bit speculative, but it's out there. And while defense stocks have rallied strongly, obviously any escalation of these tensions could put pressure on broader risk assets. third, we continue to see the China slowdown as a major global factor. Weak economic data coming out of China, plus those ongoing worries about its property sector, have weighed heavily on Asian markets and commodity currencies around the world. The market is really keenly awaiting further stimulus from Beijing. That could provide crucial support for global growth. Without it, the ripples from China's economy could definitely spread further. And finally, crypto regulation remains a significant theme. It hasn't gone away. Heightened regulatory scrutiny, alongside that profit-taking we discussed, has put pressure on cryptocurrencies. And while Bitcoin and Ethereum remain significantly up year-to-date, they are still vulnerable to further corrections depending on how these regulatory developments unfold, particularly in the US and Europe.
That's a really comprehensive look at the key themes. So, looking ahead just briefly, what specific events should you mark on your calendar for this week, the week of August 18th? What should you watch out for to help connect these dots?
Okay, well, for Monday, August 18th, we already had China's industrial production and retail sales key for gauging their slowdown, plus U.S. housing and manufacturing data. Early August signals there. Today, Tuesday, August 19th, we get crucial U.S. retail sales, ex-autos, industrial production, and importantly, the FOMC meeting minutes from July. Those minutes are always highly anticipated. They reveal policymakers' detailed views on inflation and growth, and that can directly move markets. Wednesday brings CPI data from the UK, Euro area, and Canada. That will definitely test those central bank easing narratives and could cause some currency shifts. Thursday, we have U.S. jobless claims and existing home sales, more on labor and housing. And then capping off the week on Friday, August 22nd, is the start of the Jackson Hole Economic Policy Symposium. Chair Powell's speech there is the main event. It could clarify the path for policy rates and often sets the tone for the next few months.
Right, a packed calendar indeed. So, given all these insights, wrapping things up, what are some, let's call them, operational watch items? What actionable things should you be thinking about based on this brief?
Okay, based on this brief, you might consider, for instance, rebalancing equity exposures, maybe reducing overweight positions in mega cap tech, trimming some profits there, and perhaps increasing exposure to value and defensive sectors, which could benefit from inflationary pressures or just general economic uncertainty. Also, maintaining duration hedges, basically protecting your bond portfolio from rising rates using tools like Treasury futures, could be wise given that steepening yield curve we discussed. It's also probably important to scrutinize credit quality in high-yield bonds. Maybe move up in quality if spreads widen further, as that would signal increasing risk aversion. In FX, dollar strength might persist, so hedging euro and yen exposures could make sense. And definitely keep an eye on any Bank of Japan policy shifts. Finally, monitoring energy inventories, especially those rising crude stocks and falling natural gas prices, could point to eventual supply-driven corrections. That might suggest adjustments to commodity positions. And for crypto, as we said, continue to watch regulatory developments very closely. Further news, particularly from the US and Europe, could certainly spur significant volatility.
And that concludes our deep dive into the Financial Intelligence Brief for Monday, August 18th, 2025. We've navigated through quite a bit: equity rotations, bond yield shifts, global currency moves, the crypto landscape, and those critical themes shaping the market right now.
Yeah, our goal really is to give you not just the facts, but the context and the implications behind them. So you're not just informed, but hopefully truly well-informed.
And as you reflect on these insights, here's a final provocative thought for you to consider. With the U.S. yield curve steepening, turning positive for the first time since early 2022, signaling higher term premiums, how might this fundamental shift in the cost of long-term money reshape investment strategies and capital allocation decisions across industries, not just now, but in the months and years ahead? It's a powerful signal, potentially, and its ripple effects could be quite profound for all of us.